Well, good morning. Excited to be talking with you about this. My name is Dennis Tice. I've been with Maynard a little over 30 years. I'm a CPA, a partner here, and then also a certified value growth advisor, helping businesses increase their value. And I also have with me today Jeff Allen, who is also a partner with the firm, has 15 years of experience and about a dozen years of experience with Maynard. He is accredited in business valuation as well. So those are the two accreditations that bring us to the table. And so our overall goals today, just our discussion points. Jeff will handle the basically defining what a business valuation is, go into the different types of valuations. And then also, we get a lot of questions in this area. So he's kind of boiled down the top 10 business valuation questions that he gets. And so, he'll do his best to answer those. I will go over how to, grow value inside of an organization, the impact of properly planning, to do that. We'll talk about some numbers, and then overall, it's just the potential for the unrealized value that's out there. Again, just looking at some numbers, and then we'll wrap up with 6 keys to what we feel are the 6 keys to maximizing business value. So, with that, I would like to have Jeff jump in and go over what is a business valuation. So please take it over, Jeff.
All right. Well, let's go ahead and get going here. Like Dennis said, my name is Jeff Allen. I am a CPA, also accredited in business valuation. We do a lot of this type of valuation work for all sorts of different types of owners, whether it be, in the trades like yourselves, or whether it be home health care, whether it be doctor's offices, whether it be manufacturers, all sorts of breadth of opportunity here. So one thing that we really want to share with you is kind of talk about some of the very basics of a business valuation, when it might be needed, the different levels of service that might be necessary as well, kind of high level, and then we'll give some tips here of how to be maximizing value before we get to the point of a potential sale or an acquisition. So what is a business valuation? Really simple put, it's just a process and a set of procedures used to estimate the value of an owner's interest in a business. It can be 100% of the business, it can be 10% of the business, it could be 50% of the business. So all business valuation is just the process of going through and doing that. A lot of people like to compare it. We're all familiar with like appraisals on real estate, right? You go to sell a house or buy a house or a piece of land or a building, you get an appraisal, and they come up with, they kind of walk through, they do their due diligence, they compare it to comps. We can do those similar types of things with the business valuation. There's a lot of information in some of the databases we subscribe to that allow us to be able to go in and see other private company sales throughout the United States for similar businesses. And so we can kind of help get comps on that. And then we can also look at, the earnings stream as well, and use that to help figure out like what a potential future investor would want to pay for a business, whether you are acquiring or selling. So that's what a business valuation is. So there are different levels of a business valuation. A lot of folks don't realize this. And then again, I want to make sure that we're educated on this. There is the full business valuation. It follows all these certain rules and criteria. A full valuation is, most people don't realize, is actually only required if you're trying to gift shares of a company. The IRS requires a full-blown business valuation. They're usually very expensive. They usually take quite a while to do. They produce a 60-page report that I'm not sure everybody ever reads, including the IRS, but it is required in those cases. It is the deepest level of basically an understanding that can be gained of the business. So sometimes even though they're not required, sometimes they are the best. Then there's this thing called a calculation engagement. I kind of like to look at it as like different steps. A calculation of agreement is basically we follow the rules, but we just say, rather than maybe applying 3 different methods of valuing and then seeing which one might be correct, we just agree on that up front. We say, hey, listen, I only want to look at the earnings. And I've got these last 5 years of earnings. They're pretty steady. What's the value of the company going to be? So a calculation engagement allows us to do that and still produce a report. The last level that we like to call is this consulting services. And the consulting services is literally where we partner together, we get data, and it's more than like back of the napkin, but it's a real short, usually 5-page type of calculation that we would be able to come up with and say, hey, I want to know what's this thing roughly worth that I'm buying. Hey, I want to roughly know what this thing is that I'm selling. And that's where we're able to come in and help with something like that. Again, it's much, much cheaper than a full valuation or calculation engagement. And it provides the most value because we tend to work closer with the owners on those types of engagements. So I want to make sure that we understand that valuation is a prophecy of the future. We often like to think like, well, here's my income statement from the last 5 years. So what's the thing worth? Well, we got to remember that a potential buyer, while they would like to use those income statements as a way to look back at the future, they're doing it because they want to project what the future is going to look like based on the past. Really, as an investor, you think about it, we're not buying a company for the past. We want to buy it for the future. And so valuation has to consider that. And that's the whole concept of, what's this thing worth now based on what's going to be able to do in the future. Okay. And so an operating value entity is valued based on future earnings potential. A keyword being future there. And history is being used as a guide to the future, but it's not the actual future. Now, that being said, if we have $100,000 of profit that we've done every year for the last 5 years and nothing's different, it's pretty easy to probably say that that's going to continue. Unless we say, hey, I'm losing a huge contract. Well, that's going to be something that we'd have to look at when we're trying to figure out what it would be worth to a potential investor. Like I said, the potential investor wants to know what the future business will be, not what is currently it is or has been. So a good way to do that is putting together a forecast. And a lot of times a forecast can look real similar to the past, or sometimes it looks like, hey, I just signed a massive contract with Dow, or I just, Board of Water and Lighter. I'm going to be doing this work for these new people. I'm expecting my earnings to go through the roof. Putting together the forecast will definitely help to increase value when we try to look at the future. So it's really just a prediction or an estimate of the future events, and whether they've been positive or negative. It's not a wild guess. I've done a lot of things where I've gotten some pretty crazy things from folks, believe it or not, where they're like, they show that last 5 years of 100,000, but then, the future is going to be $1 million. You're like, well, I'm not so sure. It does need to be honest and realistic, obviously, too, right? And a good way to challenge these things is to sometimes have your forecast either, challenged by peers or different departments. If you're a real big operation, you got a sales guys or something like that, they'll tell you that they're going to sell 50 million next year, right? When really we've never broke 500,000 or something like that. So, making sure that we can challenge each other's assumptions helps to produce a really good forecast. Top 10 questions and answers about business valuations. These are some of the questions that we get so often, and I just think it's helpful if we just go through them real quick here. Can you do a valuation for a test client? And a test client meaning that, I do the audit as well, or the firm does the audit as well. And the answer is, with many of these cases, possibly. So if we're dealing with a transaction where the company itself is going to be buying or selling shares back from owners, the answer is probably no. If Bill is selling to Jim, the answer is probably yes. So that is entirely possible that your accountant could do the business valuation. But can you value less than 100% of the business? Yes, absolutely. We've valued as low as 1%. I've valued as high as 100%. And it definitely can be anywhere in between. And that's certainly very doable. I get this a lot. I can't afford a full valuation. Can you do something less? Of course, the answer is yes. We just discussed that in the different levels of services. We can do that, that sort of a earnings-based calculation that costs far, far less and is very reasonable and provides a lot of value in consulting time back and forth with each other. How long does it take to complete a valuation? So if we're talking about that high end, that full valuation, it usually takes a few weeks. If we're talking about, hey, I just need to run the numbers, it can probably be done in a day or two once we're able to get it on the schedule. So it can usually be done pretty quick. How much lead time do you need to schedule a valuation? Again, it probably somewhat depends on the time of the year or whatever's on the schedule, but usually if we have at least about a week's notice, we can get things moving pretty quick and get numbers to you for just if we're doing like the basic kind of calculation. If it's the full, you may need a little bit more time. Aren't there free valuation tools on the web? The answer, of course, is yes, there are free valuation tools on the web. The only problem with that is that if you're working with a computer or a database that doesn't necessarily know your business or has spent time learning some of the intricacies or the contracts or the key personnel, it will only spit out a number. So numbers in, numbers out. It will not necessarily evaluate the qualitative aspects of the business, which could increase or decrease value. So definitely feel free to use them, but just keep in mind that, you know, what you put in is what you get out. Are minority shares less valuable? So if we're talking about 1% of the company versus 100% of the company, is a 1% less valuable? Absolutely, right? Of course it would be worth less because it doesn't have control of the company. And as such, when we would do the valuation work, we would put a discount on there for control because they don't have control, and it would show up as being less valuable. Do you need to hold an ABV credential to do a business valuation? Many people don't realize this, but you don't need a special license to do any sort of valuation work. But looking for a evaluator that has credentials means that they have passed some sort of certification process and they should know what they're doing. So just keep that in mind when you talk with folks. What if I'm not sure what I need? I know you all do sales and things as well in your line of business, but what if you're not sure what you need? Reach out, have a talk with somebody, and see if they can help walk you through that process. And how can I get the absolute best price when I sell my business? This question comes up so much, and it's really involved with the timing of when you want to sell and so many other critical things. And that's actually where I'm going to turn it over to Dennis, and he's going to help us really to dive more into this number 10 of how to get the absolute best price when I sell my business. So Dennis?
All right, well, thank you, Jeff. Appreciate the background there. And the so this is basically how I start looking at a business. You know, 8 functional areas of a business. In the upper right quadrant there, you have planning and leadership. I think those two basically sit by themselves, and then they also play a component or a role in each of the other 6 functional areas. The pieces of the pie look equal here, but you know, in any given organization, that may be you know, slightly varied, but generally they exist. And you know, so ultimately, what we are concerned with there is, you know, how do those things, you know, impact our value? Each of these areas can and usually do have an impact on value, and I think that presents itself through the, you know, the risks that any of those areas may present, or you know, really, you know, if you look at strengths and weaknesses, you know, maybe you know, those are the weaknesses, and this, you know, the strengths. If you excel or you're the best in the industry at you know, 1 or 2 or 3 things, you know, obviously that improves the quality of the company and has an impact on the value in comparison to maybe a competitor who is just average in that area. So just by example here, you know, one of those would be you know, in the sales area, customer concentration. Okay, you know, if 80% of your sales are to a you know, to one customer, that inherently causes more risk for a potential buyer than if you had, you know, 10 customers at, you know, 10% apiece, to oversimplify. You know, and you know, it's relatively simple to understand. Probably quite difficult to you know, to actually, it takes a long time to diversify and gain additional customers and you know, eliminate some of the risk from that concentration. The other another example, and literally there's hundreds of them that could come into play into the business, but just the ability to scale. And if a potential buyer is looking at you, obviously they're looking at what you do well, and they're hoping that they can grow that, and probably grow that at a rather rapid pace. So if you've built your business with the ability to make it scalable, and it's repeatable, and you can size up your business for additional projects and things of that nature, and you do that better than most companies, then that's going to should increase your value if the potential buyers is looking at the quality of the business and the actual risks that are associated with that. So one of the other things that I wanted to point out too is that if you look at the different areas of the on the wheel there, that the planning and the leadership, typically different people with different personality types have a tendency to gravitate towards certain areas of a business. And if you're familiar with a DISC profile, your dominant personalities oftentimes will end up in the planning and the leadership role. Your influencers will be in sales and marketing areas, and your supporters will be in people and operation, and your compliant people, like Jeff and I, we have a tendency to go towards finance and legal, because there's a bunch of rules involved there. So, and the reason that I mention that is because because of the different personality types. It just makes it a little harder to cross over into certain other areas. And your influencers probably have the most trouble with the finance and legal area, and dominant personalities may have the most difficulty in the people area. And so the reason I mention that is because we need to mention it. We need to work on this, as a team approach, and strengthening all 8 areas of the business, and with all the individuals that are involved with the leadership in those particular areas. Okay, so let's just talk about essentially a lot of times when people are talking about the value of their business, they say, well, I'm worth 6 times EBITDA, and that's just the number, because that's what the market is right now. That's what your golf buddy said. That's what you heard somewhere or at a conference. And I think what I'm talking about refutes that, and says, well, no, that your quality and the risks that are associated with these different areas of the business dramatically impact the value of the business. And Jeff would see that in the discount rates that are applied, that are kind of weighted in the types of risks that are associated there. And that can take you a long ways away from just a pure EBITDA multiple. So I just want to stress the caution there on just saying we're worth X times X. And so really, what I feel the process here and how to grow the value of the business is first to understand where you're at, and what are your current strengths and your weaknesses, and that's what I'm talking about on with the qualitative assessment here. Is really a significant deep dive into a SWOT analysis, where what are you great at, what could you improve at, what opportunities are out there, and what external threats could destroy what you have, or make it more challenging, impact your overall profitability and things like that for the future. Then we take that, and then we combine that with the quantitative. This is the EBITDA, this is your balance sheet, this is your income statement and cash flow statement, and which is usually the first thing that people are looking at. But it's oftentimes it's certainly important and very important, but it's not the it's not the only factor, and it can be quite misleading if you only use quantitative type information and not marry that with the actual qualitative information. So when it's all said and done, let's say you're going through a sales process and there's a due diligence team involved, they're going to try to come in and they're going to look at these qualitative aspects and say, okay, what kind of risks are associated with, with these, particular areas. And they're going to try to poke as many holes in that as possible. So they don't have to pay any more than necessary, and they protect who they're working for, which is a potential buyer. So I guess the product of those two items is the baseline intrinsic value, and it's for the most part it's heavily rooted in cash flow. So when Jeff mentioned 3 models before, this would be more of the cash producing model of your classic business valuation. So if you're heavily weighted on assets and things like that, equipment and things like that, you just have to factor that in addition to this. But from a cash flow perspective, the buyer is primarily concerned with, okay, you've shown us what kind of cash flow you have, with historical information, and maybe even provided us some projections. How sustainable, how predictable, and how transferable is that cash flow if we were to buy that company? Because that's what they're truly concerned about. Because if they buy it, and for whatever reason or reasons it's not there, then that may have been a bad investment. So that takes us to a current state, developing that, what you think the baseline intrinsic value of the business is, based on again heavily incorporating not only the financial aspects of the business, but the qualitative aspects of the business. So then we flip over to the right side there, and we talk about the future state. Well, we take what we've learned in the assessment, and we look where we can get the biggest bang for the buck. So just in general, there's different ways to do this, but I use a scale of 1 to 10, and 0 to 10 actually. But 0 is you don't do it, and 10 is you do it as well as a high quality public company, and 10s are hard to come by. But at any rate, this gives you a strong indication of which areas would be most beneficial to actually dive into and correct if you're going down the road to a future sale. Okay, and that can certainly be tailored, or needs to be tailored to your individual circumstances. Committed execution, obviously we add that in, and I think that's important here because, as we'll go over a couple of the numbers here, in just a bit, but what you'd see is, we can increase by, 40% by having X investment. Well, that's pretty simple. You just spend the money, and obviously it's not that simple. And it can be quite difficult to do. And I think one of the most difficult pieces of that is carving out the time and the energy to facilitate that process. It does, there's a lot of planning involved, a lot of longer term planning than many companies are used to doing. And it involves more than just the key executives. It involves other members of management, or maybe mid-level management, and individuals that you think eventually could be members of management. So just a few things to think about there. We start with where we think we are in the current state, and then we design where we want to go, for our future state. Okay, so from an impact perspective here, I mentioned this scale of 1 to 10 before, and again, there's different ways to do this, but if we aggregate this information, or you can aggregate all the different attributes of your business, and let's say you were 50 out of 100, it's right in the middle, right? That's kind of average, even though you have I'm sure that every one of you believes that your business is above average, but there's certain areas of your business that you probably know that you need to work on. And there's a lot of times there's things that will drag a company that's a 70 and from an operational standpoint down to a 50, because they're not addressing it, or they're not paying attention to those areas. Well, not until they don't see the importance of that until a purchaser starts kicking tires and pointing out the importance of those either systems or just the overall planning process to avoid risk. So just by way of math here, you got $2 million of free cash flow, at a multiple of 3, it garners, $6 million of value in the company. Well, if you are able to reduce your risk, improve the quality of the company, you may go from a 50 to a 60 and, increase your multiple, and let's say in this example, it's 1, we're just trying to keep the math simple. And then, maybe you can go even, you have a little bit more time, you can go from a 60 to a 70. And in that regard, maybe you increase your multiple, by 2, from 3 to 5, and you end up at $10 million. Well, that's just solely incorporating the quality of the business, and basically, how the buyer would look at the business. And I think, it's proven over time that a higher quality business making better decisions over a period of time is going to be more profitable, is going to end up with better cash flow, and overall less risk to that, or more sustainable, more transferable cash flow. And that's where the orange comes in here. So we're just a dramatization of the additional value that can be picked up by, potentially in this model, increasing the cash flow of the firm. And you can see, from 50 to 80 there, we're doubling it or tripling in value. And it's just, it's something that's achievable, not guaranteed, obviously, but achievable over time. Okay, just another way to, potentially look at this. What we would recommend is, you do that initial assessment, and that's what's in the bar graph here. That's that $5.6 million, of value. So that's your baseline intrinsic value. And then we have the different levels there. First thing we would do is address the most significant pieces of what we feel on the roadmap will give us the biggest bang for the buck, and that would be the highest risk areas, as anticipated by a potential buyer, maybe in combination with your thoughts on what causes the most risk. But those are generally foundational things, things like the customer concentration that I was talking about. Well, if you can cure or mitigate those risks, then we end up increasing our overall value. After you tackle those, then you generally would move on to maybe less significant but still significant items, and be able to increase your value yet more. Again, you're tackling more here, so it's going to take more time. And then we move into the purple here, and this generally would be things we'd be talking about, scalability of the organization, ability to grow, removing some of those roadblocks that would again, a buyer could and likely will look at for determining the overall value of the business. Okay, so our overall 6 keys here on maximizing value. Number 1 is it just takes time to do this. It takes time to, and Jeff's very familiar with this as well. Takes time to prepare for a transaction. So physically stating that we hear it all the time too. Well, I'd really like to sell my business in the next 3 months. And I'm like, oh, we could just change that unit of measure to 3 years or maybe 5 years. You just have so much more opportunity to do that. And that's if you're just trying to prepare for the transaction, much less improve value. So start early, I think that is definitely a different time frame. So number 2 is define what success looks like for you, because that's going to be likely different for any individual company and any individual owner of a company. They're going to have different goals. One may be a sole owner, that doesn't have any family to take the business over, you're looking for an outright sale at maximum value. Another may be a family business where really what you're trying to do is pass it on to the next generation, grow the next wave of leaders, and basically reduce their risk as much as possible. This process of maximizing value works very well for that as well. But you're not necessarily interested in maximizing the value there, especially if you're filing gift tax returns. But really sit down and think about what the overall goals there, rough timelines, what you need out of the business in order to oftentimes this is your biggest asset, and it's your segue to retirement, and you just really need to sit down and think about what that needs to be for you. And I'm surprised at how often we see that has not been well planned out or thought about much. Number 3 is look at the value and the risk that can drive that through the buyer's eyes. And this basically refutes the 3 times or 5 times or 7 times EBITDA thing. If those risks are looked at, and beauty's in the eye of the beholder, and then in this case it's the buyer. And so the better your company can perform with lower risks, likely the more value it is physically going to garner.
Dennis, I might just jump in real quick.
Oh yeah, Jeff, please.
This concept right here, that's looking at a value through the buyer's eyes, that's really what the entire premise of business valuation is too. We're trying to determine that riskiness of the business. So, a business that is, I'll give you a perfect example. My father-in-law, he's a builder. He builds houses for a living, does renovation work. He owns his own company. He's the only employee, and he uses a lot of subs. So, the name of his business is his name. I'm not going to say it because some of you might know who he is, and I don't want to use him as a bad example, but, Bill Jones Construction, something like that. And he'll ask me, Jeff, what do you think I could sell the place for him? And I'm like, probably not a lot, to be perfectly honest with you, because the folks that you're doing work with that are hiring you, the generals that are hiring you or whatever, they're hiring you. They're not hiring your business. And there's a big difference. And you don't have somebody coming up after you. So if you want to retire, who are you going to sell it to? You can't sell Bill Jones Construction to, Keith James or something like it. Just doesn't work because they're calling you. They're not calling Keith to do the work. And so that level of risk is super duper high for him. And really, he owns a job. He doesn't necessarily own a business per se, even though, he's got a really cool trailer and some awesome construction tools, it's kind of along that line there, So the buyer's going to look at it and be like, what's the likelihood that your guys are going to keep calling me when I own your business is probably pretty low. I might as well just go start my own business, So something that I like to use that as an example. So he doesn't like me using that as an example, but I do. So.
Yeah. Well, thank you, Jeff. I think that's a clear example of how this all plays out. Number 4 is, get a clear picture of the current state. Really sit down and think about where you're at. Be honest with what are the strengths and the weaknesses of the business. Get other people's viewpoints. Bring that into, get that more clarity around your roadblocks and challenges. And oftentimes this can bring on just a real healthy discussion about, what the real issues are. And because you're hearing it from different people, different, there's a lot of resources inside your entity, and there's a lot that can be put into play if to rectify issues or even improve the quality of the business, if they're also sitting at the table to then push that rock up the hill. So number 5, investment of resources. There's no doubt that it takes an investment of resources to physically do this. And again, I think I mentioned it before, time is one of the largest ones. I've had, we talked to a lot of people about this process, and the number one roadblock is time. And when am I going to find the time to do this? My people are too busy. I'm too busy. And if you're not going to, invest the time, then it probably doesn't make any sense to invest, money in the process either. So I think you really got to, that's where the gut check comes in, and you just say, okay, I want to retire in 5 years, or semi-retire or something like that. Am I there yet or not? And am I, are the building blocks in place? What other moves do I have to make in order to, attain or reach my goals? And that's different for everybody, and it might be different, for your 3 owners, or whatever, different family members, or what have you. So, and the thing is, there, it takes time. There's trial and error. You may have turnover or other issues that impede your best design plans. So, you need to invest those resources in combination with number one, start early and continue to do it over time.
Yeah, Dennis, I would just add on to that too. Don't want to keep interrupting you every time. Sorry, but
that's fine.
This investing this resources concept, I get this sometimes, this question, well, if I do that, then my earnings, my EBITDA is going to go down because I'm spending more. And while that might be true, the value could go up. If we can increase the value by $1 million, a $50,000 spend, 100,000, whatever it is really small in the comparison of things. And not only that, but if we can prove to a potential buyer that that's an add back to earnings because we're building for the future, we might not even actually affect an EBITDA calculation. And so that's something to think about. And I'll give you a perfect example of this. Literally working right now with a custom tool and die manufacturer. And he's invested heavily over the last 3 years out of earnings and setting the company up for a really amazing trajectory, and never planned on selling. But now he's getting to the point where, someone has approached him and he has this thing set up awesome for the future. And so, we'll be adding back a lot of those investments that he made because they're not necessarily, some of them aren't really operational, but they were investment costs that went through earnings. And so when we add those back, we're seeing that the earnings potential is really, really high for the potential investors. So, just keep that in mind, that investing doesn't necessarily mean giving something up. It means getting something more, just in a delayed route.
No, I think that's great, and a real life example of how this all comes into play. And number 6 is, in order to do this, in order to reach your goals, maximize value, improve the likelihood that you can sell your business at something that works for your needs. You need to implement robust planning process to establishing longer term goals, attacking those risks that you have, taking advantage of the strengths that you have to make them even stronger inside the organization. All of those are long-term planning processes. The vast majority of mid-sized entities do not do a great job at strategic planning. They do a pretty good job at operational planning. They don't do a great job at longer term strategic planning, looking at risks and involving people across the various disciplines of the organization. And those that do a really good job at that have a tendency to thrive over the long term. You thrive over the long term, and generally that's because you're a less risky organization, and you will have more profitability during that time frame. You combine the blue and the orange on one of my previous graphs, and you see the trajectory that the direction that can go in, and that allows you. It's a lot of work, but it allows you to attain your goals and then maybe some, after that. So that's all we had.
And, I think we just boil it all down, when you're ready to sell, if it's at all possible, try to do that few years worth of pre-planning, and it will pay off so much better for you than, hey, I got an offer, what am I worth? Kind of a concept, and going from there. So if at all possible.
And just I don't, not to for you to disclose anything, but how many businesses go through this scenario with you every year? I mean, are we talking like 20 businesses a year might be?
Well, from my perspective, it's awful difficult to have a conversation with somebody right now. Since the pandemic started, without them putting more of an eye on the future. And so from an overall standpoint, it's you're talking to 40-year-olds now, and right, and they're much more likely to say what's my end game. How 5 years ago things are riding high, and things are going well, and you're dragging people kicking and screaming to a 65-year-old to what's the plan, what's the next step, what's the end game. And so there definitely has been a shift overall in that process. I think there's a lot of activity just in discussing this with multiple clients. Statistically, I've heard various different numbers, but in the next 10 years, there's going to be more businesses for sale than any other point in history. And it's one of the reasons why we feel that this is important, to assist our clients and putting them in the best position possible for to meet their their actual end game goals. So we did have one question there that it just says can there be some discussion on finding a buyer? And I know we've dealt with a number of companies over the years that the common term would be a business broker, somebody that would help facilitate the sale, maybe put together the book, so to speak, and then take it to market. So we have a number of contacts that can do that depending on the size of the business. But what I would say to that is that realistically, what you don't just want to. I see a lot of business owners that would just want to sprint until the end and then turn over the keys. And you're putting yourself at a great disadvantage to do that if you're not looking at a lot of these things that could improve your business over a period of time. Not only would you increase value, but let's say in a down market, there were still, when it hit the fan a year and a half ago, there were still companies, high quality companies selling, but they were high quality. Everything else was either desperation, which is a situation you don't want to be in, or they weren't selling because everybody was just in a panic. And so you want to be as high of a quality of a company as possible. That means no matter where the market is, you should end up on the positive end of that curve as far as overall value goes.
Yeah, I would just say on a personal note, probably one of the worst sort of executions I've seen on a business sale was actually my uncle. He had owned an auto repair service that my grandpa had started, and he worked with him 40, 50 years or whatever, basically as a kid, and my grandpa turned it over to my uncle, and he was almost resentful of it. He's like, what do you mean I gotta buy this thing? I want to retire someday. Who do I sell it to? I don't have a kid that wants to buy this thing. And so, worked with a broker, but he wasn't set up there was no succession plan. He didn't really know what he wanted, and it didn't work out. And then, he'd been fighting for 3 years with a bad knee, and, owned the business, couldn't take vacation time to get it done because then the work doesn't get done. And so, really here, just shortly after the pandemic, he ended up just closing the doors and, referring people to to someone else that he knew in town and sold the building, so really he didn't walk away with anything. And I just think that's a shame, just because planning could have done something, we're not saying auto repair place is going to be worth tens of millions of dollars, but getting a couple $100,000 out of it would have been nice. So just as a real life example close to home, they're a good example of not good planning.
Well, hopefully we've been able to, address, some concerns of those on the call today, and we're always, our contact information is there if you need to reach out to us for any questions that you think of, post presentation. Please do. We'd be more than happy to entertain those. Thank you.